Well, good morning. Christine, speaking in front of these flags, questioned whether we were all turning French or should be turning French. So I guess standing in front of these flags, I should be asking whether the Anglo-American neoliberal free market model is bust. And, of course, that depends what you mean by Anglo-Saxon, Anglo-American, whether you think that it was a peculiarly Anglo-Saxon model, this. But I think the thing which is clear is that our existing financial system has just failed spectacularly, and that a lot of the intellectual assumptions that we had about when markets work and when they don't work have turned out to be fundamentally intellectually mistaken. And we have to understand that, and we have to recognize the scale of what therefore has to change. The global financial system has suffered a huge crisis. It's certainly the worst for 70 years. Indeed, in some ways, in its international reach and impact, you could describe it as the worst in the entire history of modern market economy, modern market capitalism of the last 200 years. And that financial crisis, which was to a significant extent the product of developments within the financial system rather than events imposed from without, has generated a severe global recession. And one of the striking features of the crisis, I think, has been how very poor we have been about foreseeing even the short-term future. With a few commendable exceptions, most apparent experts did not recognize in the boom years up to 2007 that we were heading for disaster. Indeed, the record is full of what are now somewhat embarrassing records of expert speeches explaining how financial innovation had dispersed the holding of credit risk and increased financial resilience. But what is perhaps a little more surprising is how poor was our predictive ability even once we were a full year into the crisis, even in summer or autumn 2008. Very few people foresaw in September 2008, in early September 2008, before the Lehman's weekend, that between the 15th of September and October the 10th, the global money markets would seize up almost completely. I know almost nobody who predicted that. Most of us have been surprised how long it has taken to restore confidence in the global banking system as measured by CDS spreads or bond spreads or whatever after the huge public policy interventions we've made. And most experts did not, even in October, foresee the severity of the global recession. In October, Japan was still, in the World Economic Outlook, a forecast of the IMF, anticipated to grow by 0.5% in 2009, and the forecast is now a contraction of 6.25%. We knew immediately that the financial crisis would hit economies with large financial sectors, but most experts did not anticipate, even 6 months ago, how big the impact would be on global trade and on global manufacturing demand and output. So the crisis has therefore brutally reminded us of two facts which we should always have known, but which it was too easy to ignore in the apparently golden years of what was called the Great Moderation. First, that banking systems, because they perform maturity transformation, lending long and borrowing short, depend crucially on confidence in banks and between banks, which if lost can take a long time to recover. And secondly, that if the banking system, the credit intermediation system, whether it's banking or through securitized credit, is impaired, huge economic loss can result. Much bigger economic loss than when we have a boom and bust in equity markets like the internet boom. Recent IMF research illustrates that recessions which follow or are accompanied by banking crisis are on average much deeper and longer lasting than those where banking failure is absent. Those lessons carry major implications for future regulation. Now, this crisis faces us with two challenges. First, how best to manage the macroeconomy in the short term, minimizing the scale and depth of the recession. Second, how to create a more robust banking system for the future. The answer to the first lies partly in macroeconomic policy, action to maintain nominal demand through fiscal policy, classic monetary policy, and where necessary, quantitative easing. It also requires action to accelerate the return to health of the banking system, where by health we mean not just the absence of failure, but the ability to extend sufficient credit to the real economy. That has required and may continue to require a mix of recapitalisation, funding guarantees and tail risk insurance, informed by stress tests which deliberately consider future scenarios more severe than we expect to arise. The purpose of stress tests, indeed, is to inform policy decisions which ensure that the stress scenario never, in fact, comes about. But it's actually not on the short-term challenge that I'm going to focus mainly this morning, but on the regulation and possible shape of the future banking system. Soon after I took over at the FSA in September last year, Alistair Darling asked me to assess the causes of the financial crisis and make recommendations for reform. And that review was published on March the 18th. It begins with an analysis of what went wrong. The rapid growth since the mid-1990s of a complex variant of the securitized credit intermediation model, growth of leverage in institutions and deeply embedded in products, the growth of a shadow banking system performing credit intermediation and maturity transformation functions but not subject to adequate capital and liquidity constraints, over-reliance on apparently sophisticated mathematical techniques, and a classic cycle of irrational exuberance and then irrational despair. Those factors help define what we need to put right. But I think it is also important in designing a future approach to understand two underlying lessons which stand behind that analysis. First, that not all innovation is equally socially useful, and that financial innovation, because of the particular characteristics of financial markets, can be used, and I fear was extensively used in the run-up to the crisis, to extract economic rents rather than to deliver services of real value to the real economy. Secondly, that market discipline failed, with neither bank equity, nor bank bond, nor bank CDS prices providing any significant indication of impending disaster right up to June or even July 2007, and with shareholders providing little effective restraint on excessive risk-taking. Looking forward, those two underlying conclusions imply that a major objective must be to return banking to its basic functions, providing vital services of real value to the real economy, the core functions of credit intermediation and maturity transformation which we need the banking system to do, and that we cannot rely on market discipline alone or even primarily to achieve this, or to ensure that financial instability risks are contained, but must also use robust regulation. The required reform is multifaceted, but three elements are particularly important: a macroprudential approach, major changes to capital adequacy regulation, and major changes to the regulation of liquidity. So a few comments on each of those, and then three, I believe, important open issues. First, a macroprudential approach. The Financial Services Authority in the UK has been criticised for having failed to spot emerging problems in specific institutions, and in particular in the mortgage bank Northern Rock in the years running up to 2007. And we have recognised that some criticism was valid, and we've taken steps to reform our supervisory processes. But the blunt fact is that even if we had had much better supervisory approaches in place in relation to individual institutions, it would have made only minimal difference to the evolution of the financial crisis in the UK. The far bigger failure, shared with regulators and central banks across the world, was our inability to see that the growth of the system of complex securitized credit intermediation, changing patterns of maturity transformation, and rapid cross-economy credit growth had created huge systemic risk, which you had to understand at the systemic level, not at the individual institution idiosyncratic level. We need in future, at national and global level, to analyse trends in credit growth, in whole system maturity transformation, in institutional and product embedded leverage. And we need to ensure that the emerging risks are addressed by system-wide prudential tools which can help us take away the punch bowl before the party gets out of hand, rather than solely relying on monetary policy to achieve that end. Now, there are several such potential tools of macro-prudential risk mitigation. But a clear priority is a counter-cyclical capital adequacy regime requiring banks to build up capital in good times, both in order to constrain excessive growth in the upswing and to provide buffers which can be drawn on in the downswing. And the FSA also believes that that counter-cyclicality needs to be reflected in published accounts, with, in addition to, but separate from the accounting lines we have, the fair value lines for the trading books and the impairment provisions for banking books, a forward-looking economic cycle reserve concentrating management attention on the inherently cyclical nature of banking risks. In addition to counter-cyclical capital, however, we also need more capital in total across the banking system, and in particular more capital against trading book risk, where the existing regime has proved wholly inadequate. Thirdly, we need major changes and a dramatically increased focus on liquidity. Changing techniques and patterns of maturity transformation played a crucial role in this crisis. Many banks placed increasing reliance on funding via wholesale interbank markets. In addition, maturity transformation was increasingly performed not on bank balance sheets but by non-banks and off-balance sheet vehicles, investment banks, mutual funds, SIVs. And hugely increased reliance was placed on liquidity through marketability, the idea that it was safe to fund contractually long-term assets with short-term repo finance because the assets could always be sold when needed. These changes which occurred over the last 10 to 15 years were profound, but regulators and central banks across the world failed to appreciate what was going on. Bluntly, we took our eye off the ball of liquidity while directing a huge intellectual effort to the complexity of Basel II banking book capital adequacy reform. Liquidity regulation needs to return to centre stage. The FSA is therefore already committed to introducing new liquidity regulations which will require larger buffers of high-quality, clearly liquid assets, and which will create incentives for banks to extend the tenor of their liabilities, placing less reliance on short-term wholesale deposits. The result, let us be clear, is bound to be less maturity transformation performed by each individual bank, and therefore less maturity transformation across the whole system, which is good in terms of lower total system liquidity risks, but which may have some economic consequences to which I'll turn. So there are those three core changes: a macroprudential approach, more and counter-cyclical capital, more effective liquidity regulation. And there is very significant global agreement on that agenda. But there are some areas where I think we don't have clear answers, and where I think some really quite deep reflection is required before fixing on the details of implementation. And I'd like to highlight three in particular. The first is how much more capital and how much tighter should liquidity constraints be? It's generally agreed that we need more capital across the global banking system and higher quality capital, in particular more common equity. But how much more? What are optimal banking system capital ratios? What is perhaps surprising is how little that fundamental issue has been debated over the last 10 to 15 years of intense global debate about the details of bank capital adequacy regimes. In designing the Basel II regime, we have considered in excruciating detail the relative capital treatment of different categories of risks, but we have simply assumed that total aggregate capital across the whole banking system should remain roughly what it was before. We now need, as we design a new long-term system, to address the fundamental issue we have previously avoided. That requires addressing some complex theoretical issues. The advantage of more capital is that it will increase the resilience of the system, thereby reducing the likelihood of banking crises. The apparent disadvantage, at first sight, is that higher capital requirements will increase the costs of the banking system and thus the costs to the real economy of credit intermediation. But if the Modigliani and Miller theory holds, the required additional quantity of capital is offset, at least partially, by the lower risk and thus lower cost of equity capital which a more capitalized banking system would have. A crucial issue is, therefore, whether higher capital requirements do impose a long-term macroeconomic cost, and if so, how large. Any such impact then has to be traded off versus the stability benefits of a more highly capitalized banking system. It's a trade-off between a slight decrease, perhaps, in the long-term sustainable growth rate versus the harm done by periodic setbacks to growth of the sort we're now suffering. And having just learned how harmful instability can be, we should rationally shift the trade-off towards greater stability. So I am clear that the direction of change is going to be, should be, towards a banking system which has higher equity capital, lower returns on equity capital, but also lower risk. A somewhat more boring industry, but a safer one. But how far we need to go in that direction needs careful thought. Similarly, in relation to liquidity, if in order to have a more stable system we need both at the individual bank level and the total system level to limit the degree of maturity transformation, there must, in theory, be an economic cost. If the banks have to hold more short-term assets and fund with somewhat longer-term tenor liabilities, then long-term interest rates should, theoretically, marginally increase relative to short-term in order to induce the non-bank sector to hold the converse position to the bank sector. And that slight rise in long-term interest rates would, in theory, be marginally less favourable to long-term investment. In theory, therefore, we have the same trade-off as with capital. Tighter control of liquidity may have a marginal negative impact on long-term investment and growth, but deliver the benefit of reduced instability. My review did not suggest a new Glass-Steagall type legal distinction, but rather the imposition of new capital and liquidity regimes, in particular for trading activity, which would have the likely impact that many banks would do much less proprietary trading. But if we are to go through this route, rather than a more hard and fast legal divide, we certainly need to make sure that those trading book capital and liquidity regimes are really effective. And the third option, on which I think we should be open-minded, is the idea that large, systemically important, too-big-to-fail banks should have to maintain higher capital ratios than apply on average. There are, of course, implementation difficulties in such a strategy. It would require the definition of which banks are systemically important and too big to fail, and somewhat reduce the flexibility of the authorities to respond to the particular circumstance which might pertain in future periods of financial stress. Constructive ambiguity is sometimes useful, and you'd have to get away from that if you had a clear separation. But it is certainly a possible way forward and should be evaluated alongside work on the details of the capital and liquidity regimes. And that evaluation, finally, also needs to cover the specific issues of large cross-border banks. The crisis, and in particular the failure of Lehman Brothers, has revealed what in the review I call fault lines in the regulation and supervision of cross-border banks. The essence of the problem is that global banks, or global investment banks, global firms of any sort, financial firms of any sort, are global in life, but they are national in death, or in the process of rescue from death. Decisions about fiscal and central bank support are ultimately made by home country national authorities focusing on national considerations, and in failure, specific legal entities and national specific bankruptcy procedures have major implications for different creditors. Now, we should offset these problems as much as possible via increased global coordination. Global colleges of supervisors, pre-planned cross-border crisis coordination. Both of those are major priorities of the Financial Stability Board and strongly supported by the FSA. But we also need to recognise the limitations of what we can achieve by improved international coordination. Until and unless we have a global government deploying global fiscal resources to support banks if global supervision turns out to be ineffective, some things which I do not anticipate seeing in my lifetime, then the solvency and liquidity of specific national legal entities is going to matter a lot. And so the direction of change is inevitably going to be towards national authorities demanding that the local operations of global banks are, in many cases, separately and strongly capitalized, and that ring-fenced liquidity is held at individual national entity level. And pursued to this limit, this would make global banks increasingly like holding groups of individual national banks rather than single integrated businesses. That, of course, raises concerns among major international banks. They would like to be able to manage their capital and liquidity on as global a basis as possible, and they argue that national ring-fencing of capital and liquidity increases total costs of operation. And that, in turn, it may be argued, might have consequences for the ability of global banks to play their role in lubricating the flows of capital and trade, which are vital to a successful global economy, recognizing that a global market economy is still the best way we know to deliver prosperity to people. So we need to understand whether and to what extent and in what circumstances that is a valid argument. This is, of course, a subset of the issue I posed above. When we require the banking system to hold more capital or more liquidity, what consequences follow for macroeconomic performance for long-term growth? We need to answer that in general and specifically as it relates to cross-border banks required to hold capital and liquidity at local level. And I don't think today we actually really do understand what the answers to those questions are. We need some detailed reflection and analysis. But it is important to be clear what the question is. It cannot be simply, would tighter capital and liquidity constraints imposed at group level as well as at national entity level have hassle factor consequences and cost-based consequences for individual global banks? Obviously they would. You don't even have to answer the question to have the answer. Instead, the question has to be, what are the macroeconomic consequences of these constraints, and how should any implications for long-term investment and growth be traded off against the benefits of greater stability? And overall, the value of financial stability needs to be central to our deliberations. The cost of the recession we now face in lost output, in postponed investment, and in the human welfare of individuals affected by unemployment and sudden losses in wealth is huge. Any benefits of the wave of complex financial innovation we have been through would have had to be very large to outweigh these costs. But it is unclear that that wave of financial innovation could ever have delivered significant enough benefits, even if it had not also created major instability. We need to focus strongly on financial stability, and we need to design a banking system and credit intermediation system focused on its core and essential functions in the real economy and better able to be a shock absorber rather than, as it has been, itself a source of instability. Thank you very much.
One of the things I do not bring is a good sense of timing, since, as you point out, I took this job, I think, December of 2007 was when I first got into the CEO job, so not the best timing I've ever had, but right ahead of Lord Turner there, I guess, who came in even right in the middle of the fire. What I thought I'd talk about just briefly is a little bit on where I think we are, a little bit on how we got here, a little bit on how to move forward, and then a couple of specific suggestions about what to do. First, I'll start with some things that I think we're all pretty familiar with. It's obvious no matter where we look, the foundation is pretty unsettled underneath us. Even if we're at a company that's doing well, a lot of us feel very, very apprehensive when we look around us. I think if you listen to a lot of Lord Turner's remarks, one of the themes that came through that was, as we've tried to manage all the risk around us, I think opacity was not our friend in this environment. Now, that may sound a little self-serving coming from the person who runs the largest regulated, transparent market, but I think the issues have clearly been exacerbated by opacity in our markets. I think the actions, at least in this country, that our government have taken around stimulus, that the Treasury took last year to try to get various programs running, I think the good news is they were directionally correct. The other news is these things all take time to find their way through the system. I was asked last week what I thought about the March and April rally, and I would call it a rally. March certainly was a heck of a lot better than January and February, and I think I'm actually more comforted by the fact that April's been fairly stable. My nervousness in March was that it was too much too quickly, and I still believe we are in what I call a trader's market rather than an investor's market, which tells me we have not restored confidence adequately. I think people are still more psychologically focused. And it remains to be seen whether the equity investing culture in the United States, that to me has been pretty damaged by the crisis, it remains to be seen whether that damage is irreparable. I also think, just to throw in one more thing to show we're still climbing uphill, the expectations for our new president, from my point of view, are maybe we'll get some new news here.
Okay.
So
Christine Lagarde leaving by helicopter, maybe.
maybe
I'm not sure.
something, I don't know. So
Okay, carry on.
I guess the good news is that's not, they didn't just add to the financial crisis, so that's the good news. If there's any silver lining to that one. But as I started to say, we have a new president for whom I think the expectations, quite frankly, not just in the U.S. but around the world, are unrealistically high. So that's where we are. So now some might ask how we got here. And I may be in the minority on this, but I've heard a few too many people say that the situation we're in is unprecedented and surprising, and I am in the camp that says it's actually neither. I will not speak for the global landscape. I'll just speak for America. But let's think about the approach the United States has taken. First of all, we have a free market philosophy in this country. Secondly, we have a largely self-regulated financial services industry in this country. And thirdly, I think we've had a regulatory landscape that has been positioned to, by definition, be unable to keep up with the rapid pace of innovation. You've heard a lot on Capitol Hill describe some of our regulators as incompetent. I wouldn't say that. I would say suboptimally resourced, maybe. But bottom line is not positioned to keep up with the pace of innovation. And I think Lord Turner made some spot-on remarks about what that financial innovation has led to. So to me, this combination of a free market philosophy, a largely self-regulated industry, and a regulatory landscape that we've refused to change and evolve and adopt, largely because of, frankly, turf battles, strikes me as not that the outcome here is not surprising or unprecedented. In fact, I think this is what the United States signs up for roughly every 8 or 10 years. So what will it take to move us forward? I've shared some of these remarks with the people I've spoken to in Washington, because I think it is critically important now that if we are going to begin to turn the tide, while it's critically important to evaluate how we got here, I think it's more important to be focused on how we move forward. I think it's clear that the way Washington works and the way our country works, there is demand from a lot of the voting populace right now for politicians to show their fervor, show their anger, haul people in, make sure that there's plenty of interrogating, et cetera, et cetera. And while that's important, and that may be what the public wants, I actually think what the public needs is for us to focus our collective energy and wisdom on moving forward and charting a way to get through the crisis. So I think it's about looking where we're going, not looking where we've been. I think it's about unity and cooperation, and I was very pleased as an observer to see just how well the G20's come together. If you listen to Minister Lagarde's remarks, I think this idea of raising the standard generally, setting a standard that the world's leading economies have to adhere to eliminate these uncooperative jurisdictions and their behavior, and to really dramatically reduce the likelihood for regulatory arbitrage, or I think, as Christine said, forum shopping. I think that's sent an incredibly positive message. At the same time, we must remember that the governments in many of these countries have had to get involved out of necessity. Lord Turner talked a lot about stability. The governments didn't ask to get involved. They had to get involved, and it was very, very critical that they get involved, because stability must be maintained above all. But we've got to be cognizant of the impact that the government involvement is going to have on the businesses that they're now involved in, and the overall financial services industry and its equilibrium. So I think before we talk about more specific ways to move forward, I think one thing we've all got to do, as hard as it may be, is continue to over-communicate. I'm in the camp that says our new president was elected largely because of his campaign's ability to communicate through all the various media channels, and I thought he did it better than any other presidential candidate in the history of the United States. I think now the expectation of the voting populace, especially now that they see much of their own money being used to fund the recovery programs, I think they will continue to insist on being over-communicated with, and we realize that that's more challenging for a sitting president than for a presidential candidate, but I don't think it's optional. And I think forums like this are terrific because you get to hear from leaders like Lord Turner and Minister Lagarde who are at the coalface on these issues, and I think we must continue to over-communicate so that we can get people feeling confident that the right people are working and taking this obviously very seriously and stopping at nothing to figure out a way to navigate us through the crisis. To conclude, I think this is about confidence, it's about capital, it's about time. I get asked a lot in my position, what are we going to do to restore investors' confidence? I think that's interesting, but I think that's a secondary question. I think first we must think of the individuals as consumers first, investors second. I think people are much more worried about their jobs, their homes, and their families than they are about their asset allocation right now. And I think we will build their confidence to come back to the markets and to think about investing if we rebuild their confidence as consumers. I think we've got to stimulate capital formation. I think while changes have been made and while improvements are on the horizon, I think credit is still too tight. I've been particularly focused on making sure some more of the stimulus is focused directly on getting credit to small businesses, because I would love for us to be able to look back at this time and say, the crisis of 08 and 09 was a time when many great entrepreneurial organizations got their start, and I would hope that if we look back 20 or 30 years from now, we're saying that the government did exactly what it needed to, got some of that credit to small businesses, because face it, a lot of people who have great ideas and have always been willing to start their own businesses, the risk-reward relationship for them just changed dramatically. Many more of them are ready to start their own businesses right now, and I think we should be in a position where we are facilitating that move rather than discouraging it. I think we have to insist on transparency and accountability, to state the obvious. Transparency will come naturally with re-regulation, but it's got to go beyond that, and we've got to have people who are going to stand up and be accountable for their companies and their companies' actions. And most importantly, we must be patient. It's going to take time. Americans are not a terribly patient group, and we're going to have to be on this one. We know we're in a hurry. I think while the crisis is not unprecedented in my view or surprising, I think the amount of stimulus that the world's leading economies are throwing at the problem is unprecedented. I think this will have a positive impact. I just think we have to be patient. A few specific ideas to consider if we are going to restore and reinvigorate the financial system, which is needed, but it has to be done in the proper way. One of the things we kicked around in Davos that was actually one of Adair's ideas was to regulate by activity. So as the financial institutions have gotten more complex, I think we've got to look at the regulatory landscape in each country and understand that certain of these companies, if they want to have diversified business models, will have to accept that the regulatory framework underneath them and around them has to change. And we can't expect, for example, the national insurance regulator to be able to effectively regulate all the activities that a company like AIG was engaged in. If financial institutions want to be diversified financial institutions, that's great. But I think the environment of re-regulation would suggest then they will have to be surrounded by a different cadre of regulators rather than expecting one regulator who may have historically regulated them to be able to do the job. We are in the middle of rethinking the short selling rules in this country. As someone who's been trading in the markets for 25 years, I'm not going to tell you that a change to the short selling rules or a return to some kind of a price test is necessarily the be-all to end-all. I'm not even sure anyone in the room could produce economic empirical evidence that it in fact is a benefit or a disbenefit. I'm not sure that's what we're being asked. What we're being asked is what are some of the ways we can restore confidence and repair people's and impaired, damaged psyches. And I think the short sell rule changes that are being contemplated will do that. So I am quite sure we will end up with some kind of a price test, and I think we'll be debating how frequently that price test will be applied, i.e. will it be applied all the time or just when specific companies are under distress on a given day. I think we've got to balance the ideals and the realities of mark-to-market accounting. I think some flexibility in the short run is called for, but I think part of what has to come out of the overall regulatory plan is clearer mark-to-market rules, a little more flexibility, again, balancing the ideals and the realities. I think just to throw one in there that's hard to accomplish, I think we've got to effectively try to address unnecessary and frivolous litigation. If I hear one reason from companies around the world more than any why they don't access the U.S. capital markets anymore, it is their fear of class action lawsuits. It is not independent boards. It is not Sarbanes-Oxley. I think all those things are easily overcome, particularly in an environment where the standards of the G20 will look a lot more alike than different. I think class action litigation in this country remains a big problem. And lastly, I would just ask that we all remember that business isn't bad. I was reminded at a dinner I had with a few CEOs the other night, a quote that one of our politicians used a few years ago and then regrettably dropped. That I think the quote went something like, "You can't love jobs and hate the people who create them." And I will tell you that I stand before you as the CEO of NYSE Euronext, and just our U.S. listed companies alone employ more than 35 million people in this country alone. So I think the fact is a lot of business is good. That's where the jobs are, and I hope that whatever we do to regain confidence and restart the economic engine, we don't lose sight of that. Thank you.
The Eurosystem's balance sheet will roughly double, and the Bank of Japan is a bit behind all of that. But the important thing to think about here is that not only will the financial system change, not only are the financial markets likely to change, institutional regulation, supervision, and as Minister Lagarde said, we're going to think about regulating and supervising products, markets, and institutions all in some sort of holistic sort of way. Central banking is going to have to change as well. The important, I think, if we look, if we want to start thinking about the changes in central banks, I think we can look at the activities that have occurred recently, because they are primarily under the heading of what I would call lender of last resort, and have been attempts, at least initially, to follow the tenets set out by Walter Bagehot in 1873. I think it's useful. I found it useful anyway. Go back, instead of reading what everybody says Bagehot wrote, read what Bagehot actually wrote. And it's a quaint idea, I realize, but if you read what I have on the slide, and this is one of the reasons I like slides, is that the most interesting thing about this is these are three parts of a long paragraph that I've taken out of a particular page in Lombard Street. But the most interesting word in that I find to be public. So if you look at that, in fact, interestingly, Walter Bagehot was not advocating lending only to banks, even broadly construed. He was actually advocating lending to everybody. But there are three parts. There are three parts of this. There's who you lend to. There's at what price you do the lending, and then there's also what sort of collateral you take as security for this. And I think it's important for us to realize that many of the problems that Lord Turner pointed to occurring in the current crisis occurred despite the fact that we thought we had mechanisms in place in the central banking world to avoid things like liquidity crises. The whole idea of the lender of last resort was to avoid that, and obviously it failed. So let me try and quickly, and I realize that we're well over the time for this particular session. Let me try and ask two questions, and I'll go through a few things rather rapidly. And at least for the first part of this, there's a paper exists. It's on the Federal Reserve Bank of New York's website, associated with a conference that occurred in February. So that's my academic part, is that I write all of this stuff down in excruciating detail. So lots and lots of words. Are the principles laid out by Bagehot still valid? And in light of the crisis, what are the main challenges going forward for central banks as lenders of last resort? On the first question, Let me just very quickly tell you there's been an academic, sort of a partially academic, partially very practical debate about whether it makes any sense to talk about liquidity versus solvency. If you have to go to the central bank for funds, then you're probably in a circumstance in which other people don't want to lend to you. And if that's the case, then probably the distinction between liquidity and solvency doesn't make a whole lot of sense. Or if it's in the middle of a crisis, then the problem is that you can't sell assets because markets aren't functioning well, and that means you probably can't value them properly either, at least that would be my view, and again, it's very hard to know. A second issue that's arisen in academic debate, and the reason I bring both of these up is that as a practical matter, they've both arisen in a very, very big way recently, is do you want to do this through lending to individual institutions, or just by buying stuff and throwing the central bank money out into the banking system and letting them allocate it themselves? And I would actually claim that both of these distinctions have become, in the current environment, kind of irrelevant. And so lots of the debate that's occurred over the Bagehot principles, in my view, has run up against sort of the practical realities of the financial crisis. And instead, I think we want to distinguish between three kinds of liquidity shortages and the types of actions that central banks might take when faced with each one of those. And the shortages that we have here are a shortage of central bank liquidity that could occur in the short term, something that's acute but occurs at an individual institution, and finally something that's systemic. So let me talk about those quickly, each one. So in the case of the first, I would say that the best examples, since we should have put also the 9/11 example on here. I think that the best examples here that I would point to, there was a fun, just sort of an amusing case, for those of you that don't know it, of the Bank of New York in 1985. 1985, for those of you that are old enough, was a period when computers had limited memory, and 64,000 was a really important number. And if the trades came in fast and furiously, and you didn't manage to clear the first one before the 64,000th and first one came in, then you could overwrite the address of the first one and not know who you were supposed to be paying. or who you were supposed to receive money from. And this happened in a big way, and the Bank of New York needed $23 billion overnight in order to fix this computer problem, which was an all-assets loan, just in case you were wondering, including the furniture and the buildings and everything. But that's a matter of public record. There are no solvency concerns in this. It's really an issue of making sure that the payment system continues to function smoothly, something similar to what happened in 9/11, when again the Bank of New York was involved, because their primary and secondary sites for clearing and settlement of transactions were both within roughly a quarter of a mile of where we're standing right now, or you're sitting. But anyway, the second one is acute shortages of financial liquidity at specific institutions. We've seen a lot of this recently. This is what I would call the sort of Northern Rock case. This actually is a solvency concern by and large. You know, again, for those of you with long memories in this country, since I come from this country, I don't live here today, right now, but Continental Illinois was my first experience with something like this, and there are clear solvency concerns, but in order to keep institutions operating for the public benefit and to wind them down, you provide them with funds in the short term. And in the case of systemic shortages of funding and market liquidity, that's what we're seeing right now. That's basically when the whole thing breaks down. October 1987 might have been the first case in which we saw something like this, although it was extremely brief because of the actions that were taken. But it's very, very destructive. There's an evaporation of confidence in the system. There are coordination failures associated with market participants, and markets become subject to runs in these sorts of cases. You can look and see across various things whether or not you want, according to Bagehot, how is it that you want to do these things? Do you want to distinguish liquidity and solvency? My basic view when I filled in this table for the presentation was that these distinctions make much less sense as you move across this table from left to right, and it really, I think, is important to keep this in mind as we go forward. Finally, my second question is, what are the main challenges to central banks going forward? And here I think there are two very big questions that arise related to much of what the previous speakers, all three of them, were mentioning. The first one is, can we separate this sort of liquidity provision function of the lender of last resort from monetary policy per se? And secondly, how should we think about this as the financial system has become much more market-based rather than just purely institution-based? And I think those are two extremely important questions. There's a typo on this here where it should say that there's a clear separation possible only in the type of the first two kinds of from the first kinds of shortage. But let me jump more to sort of very basic ideas here and say some things I think that really I think can try and help move this forward. Unconventional policies have, unfortunately, fiscal implications, and I think it's very important for us to keep that in mind as we go forward, because I think that we have to be very cognizant of the fact that unconventional policies of the type that we are seeing are aimed at things like credit spreads and specific issuers of debt. This is a very, from coming out of the central banking world, I have to say that as I say that, it sounds really bizarre to me, because one of the primary principles that I always thought we should apply to central bank balance sheet management was asset neutrality. The idea was that you were not supposed to prefer one asset over another. And that's why there were severe limitations placed on the sorts of things that would be purchased outright and that would be taken as collateral by central banks. We've obviously moved light years away from that. And we've moved into a world where we're preferring very clearly as central banks to purchase or to try and make markets in one asset relative to another. Now, let me just point out that that this can be, and people have said this, look a lot like what back in the days when I had my first job as an economist 30 years ago, I guess, we called industrial policy. And so if you can think about this pretty clearly once you realize that if the central bank has the ability to issue its own debt, which most central banks in the world do, they can issue that debt, central bank bills, which is essentially like treasury debt, but without legislative approval, unless it's carefully structured, and then they can use the proceeds of that to finance specific issuers. And I have to say that this troubles me quite a lot. And I hope that that's not the central bank of the future, because it's not the central bank that's associated with asset neutrality. But we have to get ourselves out of the current circumstance first. Finally, and my last slide is about market versus versus market-based financial systems. Traditional lender of last resort functions, the whole idea was that you supported institutions, and by supporting institutions, you were able to support their ability to operate in markets, and it was indirect. Essentially. I should point out, as I think is clear to most people, and is the subtext of some of what both Minister Lagarde and Lord Turner said, that we had this idea, which is now clearly wrong, that we could control or supervise and regulate specific securities as well as specific markets through our regulation of institutions, and that was our primary leverage. Now, there was other kind of regulation, but that was not primarily where it was focused, and we thought we could take care of those problems. I think here we've also learned that we need to broaden the scope in which we think about this, and we need to be thinking much more about how it is that the central bank can ensure that markets remain liquid, albeit, as I said before, trying to ensure various forms of asset neutrality in the long run, And we have to stop thinking about markets and institutions also, this is very, very important, as substitutes for one another. We need them both. They critically rely on each other. And the central bank, as the protector of this system, on a day-to-day basis, has to ensure not that just one of them is able to operate over, from one day to the next and 1 week to the next, but that both of them are. Thank you very much.
Steve, thank you very much, and thanks for, I know it's always difficult being last on the line, and we've had so many good ideas and so much stuff out there. As you noted, we're a little off time, but you very kindly brought us back in. We've got literally 5 or 10 minutes maximum for Q&A, because we have a big program coming up ahead of lunch, and obviously Jean-Claude Trichet at lunch itself. So I'm not going to try and do a quick synopsis of all of the points that have been raised here. A, too complicated, too many good ones. I'm going to pull together maybe 2 or 3 questions, give a chance for different members of the panel to comment on them, maybe even comment on some of the items they heard from each other if they thought there was anything that they wanted to comment on each other's comments as they go along. I can see somebody waiting right down here. There's a microphone behind you, sir. If you just let us know who you are, as we did before, that'd be great.
Yes, Neil Smith, EHS Partners. Question is really for Adair, as he was addressing this sort of too big to fail. And I think summary, there were probably 3 options. I think he concluded the first one is let them fail. The second one is sort of live with them, and the third one is increase their capital requirements. I wonder if there isn't perhaps a 4th option, and the 4th option just simplistically would seem to be prevent banks from becoming too big to fail, and secondly, disincent those that are too big to fail to be not too big to fail. For example, can you sort of reflect the true economics of those banks and sort of motivate them to reduce themselves in size?
Great. There's a question at the back there. Yes, somebody's coming behind you, madam. Yep.
Diana Torres from the Partnership for New York City. My question is slightly different. I'm curious to know from both Lord Turner and from Mr. Niederauer how you think the 2 global financial capitals of New York and London will emerge from this crisis. Will they be strengthened or weakened?
Oh yeah, that's always the underlying question. First of all, madam, were you asking? So then I'll go. Yep, madam there. Thank you.
Do you think, can you hear me?
Yes, we can, yep.
Do you think that the fractional reserve banking system is fundamentally flawed, inasmuch as at the time of the creation of the debt, no concomitant issue of capital to pay the interest on that debt is issued? And when the original borrower does not have a continuation of earnings to pay that interest, the money must be drawn from other areas. And therefore, the practice of deleveraging begins. And should we really examine that fundamental question?
That sounds like a very important point. Madam, you're waiting here at the front. I think I may have to stop them there and see how we do with those 4.
Kathy Shanling, International Private Water Association, which is all about public-private partnerships in the water sector, infrastructure finance. 1997, we had the Asia crisis, and that was all about highly leveraged infrastructure deals, highly leveraged other type of deals and projects, mismatched currencies. In the early 2000s, we had the Enron scandal, as well as the riskiness in investing in different types of technologies, the technology bubble. Now we have this crisis, which I call Mickey Mouse mortgage crisis. And sorting out what's going to happen next, how do we get out of this situation? How do we get the markets to move again? How do we start investing in infrastructure again? The World Bank's numbers, 30% drop in investment in infrastructure around the world. What's going to be different so that we don't have 10 years from now yet another crisis similar to what we had in Enron, similar to what we had in 1997. What I've noticed, there's very little link that's been said in the media between what's going on now and what happened in 1997.
I've heard a lot of people say that everything that's been worked out here, and I think we've certainly heard in Christine Lagarde's comments, will perhaps prevent this crisis from happening again. Whether it's going to prevent a different crisis from happening again is probably a much harder issue to raise. We've got 4 points there. If I could just throw one broad kind of overarching kind of question on top of it as a non-financial person, I thought one of the most remarkable statements made at the recent G20 London summit was for Prime Minister Gordon Brown to step up and say, this is the end of the Washington Consensus. It's quite a bold, even provocative statement to have made, and it gave the impression that there may be a difference between a UK approach, along with continental European partners, and perhaps what had certainly been a US approach in the past that Britain and others have been part of, but that might be a part. I just wondered whether that comment in itself, what it provokes in each of you as we come to the end. But let me start with you, Adair, as you were the person to speak first. Take one or two of those questions. A couple were addressed directly to you.
Well, let me begin with that final one, and your comment, Robin, and the question here is this the end of the Washington Consensus? In some sense I think it is. I do think that we have been through 20 years of a very, very strong conventional wisdom about the almost limitless benefits of market liberalisation and deregulation, in which we have failed to understand that markets are different, that there are some markets where the case for deregulation is almost absolute. Anybody who doesn't believe that restaurants are best run by the private sector never went beyond the Iron Curtain before it came down. And where there are no systemic problems about doing that, and where you can have let 1,000 flowers bloom, and if they happen, and some will flourish and some won't. And there are others which are different. And financial markets are different, and banking is even different from financial markets. And I think we oversimplistically went around the world, publicising the argument for immediate and rapid and in all aspects deregulation of financial markets in a way that we've had a wake-up call, and it was the wrong thing to do. Now, that doesn't mean we're not going to have a free market financial system. We're going to have private sector banks, we're going to have markets, we're going to have equity markets, but we are going to have to think far more carefully about how these operate and when they will operate effectively. I think we have had an entire academic construct of efficient and rational markets about which there are major questions about under what conditions and to what extent liquid financial markets are either efficient or rational. I think some of what we've written is wrong. I think, therefore, we've got to seize the opportunity. We've got to, as it were, clutch a silver lining among these terrible clouds and at least make sure that we now do fundamentally look at the regulation of the world financial system to make it sound for the future in a way that after Asia and after Enron, we sort of thought, well, there are one or two problems, but actually, they've gone away. The system has absorbed it, so we don't need to respond. Just very quickly on too big to fail. I don't think you can simply say that you can just let them fail. I think that will always be difficult. The second option is not do nothing. It is more capital requirements, particularly against trading books. It's more ferocious supervisory attention to what are the proprietary risks that large commercial banks are taking. The third may actually achieve what whoever it was wanted, which is, it incentivizes in some senses banks not to get too big. I mean, if we demand higher capital requirements off larger banks because they are too big to fail, that will place some limits. It will still mean some banks get very big if there truly are global synergies and global economies of scale in getting big enough to overcome the extra capital requirements. But that is in a sense saying, it's essentially saying, recognizing that the fundamental problem we have here, I think, is that there are costs of externalities, costs of financial instability to the overall system, which it will never be sensible or rational for individual bank management to internalise into their individual decision making. And we need mechanisms, either regulation or whatever, to make sure that those externalities of instability are reflected. Just one final point, though. Let's not iconise small banks. I mean, we can go to the other extreme and say, let's have lots and lots of small banks, right? And each one of them will be small enough that we can fail. Well, actually, small banks can still be interconnected banks. The Great Depression was fundamentally a banking crisis primarily of small banks. It was domino after domino after domino keels over across the country. So we have to be very careful in these debates of not leaping from the problems that we've got and then iconising some other system which has also revealed problems in the past.
Steve.
It's tough to come after Lord Turner, who answered questions so well. But let me make several very quick points. The first one is I actually believe that we have to be very careful with the idea of too big to fail. And I just want to make sure everybody realizes this. If we try and get, as some people seem to want, an authority like something that comes out of the Financial Stability Board or the IMF or my own institution to walk around and certify institutions as too big to fail. I mean, this is a very big danger. That means, of course, that what you do when you certify somebody as too big to fail is you certify others as small enough to fail. And if I were a depositor, I know what I would do next, okay? So the transition to this world, and I agree completely with the idea of taxing bigness in order to let the markets determine the appropriate scale and scope of the institutions. And it's getting the tax rate right might be pretty hard, but that was, we'll work on that. But I do worry about too big to fail. I guess I'll take the technical question about fractional reserve banking system. I think that the fractional reserve banking, I hope it's here to stay. The alternative to the fractional reserve banking system, I would rather put my funds into a well-capitalized bank, say one that had 25% capital, which was the amount before, in this country, before deposit insurance was instituted, than put it in a money market fund that has no capital. The money market fund, of course, is supposed to have matched assets and liabilities, but it doesn't really kind of work out that way because they can't always sell them. Finally, a quick point about learning from past experience. I think that we are being very cognizant of all of the past crises that have occurred around the world. In trying to design a framework for understanding how to regulate and supervise the financial system and allow for resolution, but we're still going to have financial crises. So the question is, how can we make the system resilient? Not how can we avoid them entirely? That's not going to happen. Thank you.
Duncan, last comment before we have to break very quickly.
Sure. I was going to tackle the fractional reserve.
Oh, sorry.
Sorry. These panels are full.
Good.
That was the only one you got.
Unlike you, I'm quite happy to be following you. I wouldn't have been able to take that one. We're clearly going to get a period of re-regulation. I think it's hard to argue against it. I just hope it's not over-regulation, if I can put in a small commercial there. What we've said in Washington and in other places is that it turns out that something we could be proud of in the crisis is that the world's regulated markets actually held up pretty well and did our collective job. So maybe smarter application of some existing regulation is a much faster way to get to where we're trying to get to than trying to spend the next 2 or 3 years figuring out how to avert this kind of crisis the next time. It turns out we do have markets that work. Maybe more of these products could be under that collective umbrella and things would work better. So I think that will be point number one. I am with the group that says I'm a little less optimistic about our ability to foresee future crises. We seem to be really good at solving for the problem that just happened, and I think it's, I guess, our collective responsibility to try to get better at solving future problems. I think everyone's focused on that. History would say we've always been focused on that. We don't have a plethora of success in that arena. And I'll try to answer one of the questions that wasn't answered about the U.S.-UK relative competitiveness, etc. I think the more that the G20 equalizes and the standards are kind of difficult to discern, I think that's marginally better for the United States. I think, maybe we had this period where it was all about free markets. It was all about deregulation. I think when I travel around the world, generally the U.S. is still viewed in many ways as a very highly regulated enterprise. a very highly regulated jurisdiction in which to run your enterprise. So I think any kind of equalization of the standard there is actually marginally better for the U.S. So I'll stop there in the interest of time.
Thank you. And I know Lord Turner's trying to make sure that the UK has an equally well-regulated setup, so maybe the competitive element is still going to be there. And the big question, I think, about the G20 process in the end, who's going to be designing within the FSB, for example, these regulations? Because as much as we broaden this into a G20 format, it's still probably the US and the UK, in particular maybe France as well, that have some of the best ideas, and how people play in on that is going to be quite interesting to see. Look, we've had a fantastic set of presentations. We've gone over time. Thank you for being patient. There's coffee and so on outside there. I don't think we'll get more than 10 minutes for a break. We'll try and call you in by 11:15 at the latest, 11:15. But please, a hand for our panelists. Thank you very much. Thank you.